Have you ever wondered why your favorite streaming service, social media platform, or online marketplace can make billions in your country but pay almost nothing in local taxes? It's a question that's shaking up governments and rewriting the rules of the global economy. How do you tax a business that exists everywhere and nowhere at the same time? Welcome to the Economy Unpacked Daily YouTube channel. From Wall Street to your street, we share the world of money in a clear way. Today, we're diving into one of the most pressing economic challenges of our time: digital taxation. The world is rapidly shifting to a digital-first economy, where value is created online, across borders, and at a scale previously unimaginable. But while digital giants generate massive revenues from users in virtually every country, their tax contributions often pale in comparison to traditional brick-and-mortar businesses. This isn't just an accounting puzzle. It's a matter of fundamental fairness. As governments grapple with funding essential public services like schools, hospitals, and infrastructure, the need to create a sustainable and equitable tax system for the digital age has become incredibly urgent. The rise of the digital economy has been nothing short of explosive. We see it in every corner of our lives. E-commerce platforms like Amazon have transformed how we shop, while streaming services like Netflix and Spotify have redefined entertainment. The platform economy, powered by companies such as Uber and Airbnb, has blurred the lines between personal assets and commercial services. And the gig economy, facilitated by platforms like Upwork and Fiverr, has created a global marketplace for freelance talent. These sectors aren't just growing, they are fundamentally reshaping the nature of commerce, making it increasingly difficult to determine where economic activity truly takes place. This rapid borderless expansion has created a significant tax gap, where immense profits are generated but little tax is collected in the markets where consumers live. So, why do our traditional tax systems fall so short when it comes to these digital business models? For over a century, the global tax framework has been built on a simple principle: physical presence. A company paid taxes in a country where it had a tangible footprint, a factory, a network of stores, or a corporate office. This system worked well when value was tied to physical goods and local operations. Digital businesses, however, operate in a completely different paradigm. They can provide services, sell products, and extract immense value from millions of consumers in a country without having any significant physical presence there. As a result, they can legally book their revenues and profits in low-tax jurisdictions, effectively sidestepping their obligation to contribute to the societies that help generate their wealth. This creates a deeply uneven playing field, where local businesses pay their fair share while global tech giants play by a different set of rules. This growing disparity has ignited a fierce global debate, leading many countries to take matters into their own hands through digital service taxes, or ADST is essentially a tax levied on the revenues, not the profits, that a digital company generates within a specific country. Nations like France, the United Kingdom, and India have been pioneers in introducing these taxes, arguing that they are a necessary interim measure to capture some of the value created within their borders. However, this unilateral approach has triggered significant international pushback, most notably from the United States. The U.S. government argues that DSTs unfairly discriminate against its dominant tech giants, such as Google, Apple, Facebook, and Amazon, and has threatened retaliatory tariffs in response, turning a tax issue into a potential trade war. The lack of global consensus is starkly illustrated by the diverse approaches taken by different countries and blocs. The United States has consistently resisted unilateral DSTs, instead pushing for a comprehensive global agreement negotiated through the Organization for Economic Cooperation and Development, OECD. In contrast, the European Union has been a leading advocate for coordinated digital taxation, with many of its member states either implementing or considering their own DSTs while also pushing for an EU-wide solution. Meanwhile, other countries like Australia and Canada are carefully navigating their own paths. They are exploring or implementing their own digital taxes to address domestic revenue needs. But they must also balance these actions against the risk of damaging trade relationships, particularly with the U.S. This patchwork of policies highlights the deep divisions and the complexity of finding a solution that works for everyone. At the heart of this challenge lies the immense difficulty of fairly taxing global tech giants. Companies like Google, Amazon, Apple, Facebook, and Microsoft have mastered the art of tax optimization through incredibly complex corporate structures. They are renowned for shifting profits from high-tax countries where their customers are low-tax havens, such as Ireland, Luxembourg, or Bermuda. This practice, while often legal, allows them to significantly reduce their overall tax burden for governments. This presents a formidable challenge. How can they capture a fair share of the revenue generated in their jurisdictions without inadvertently harming innovation, discouraging foreign investment, or creating a hostile business environment? It's a delicate balancing act with billions of dollars at stake. The rush to implement national DSTs has also introduced the serious risk of double taxation and escalating trade tensions. When a company's revenue is taxed in the country where it is generated via a DST, and its profits are taxed in its home country or another jurisdiction, there's a clear danger of taxing the same income multiple times. This creates uncertainty and added costs for businesses, which could ultimately be passed on to consumers. Furthermore, the dispute is not confined to tax offices. When the U.S. threatened to impose tariffs on French goods like wine and cheese in retaliation for France's DST, it became clear how quickly taxation disputes can spill over into broader trade wars. This tit-for-tat dynamic creates instability for the entire global economy, affecting businesses and consumers far beyond the tech sector. This brings us to the core policy dilemma. How can governments design a tax system that ensures fair contribution without stifling the very innovation that drives economic growth? If taxes on digital activities are set too high or designed too poorly, they could discourage startups, hinder technological advancement, and slow down the growth of the digital economy. On the other hand, if taxes are too low or easily avoidable, the burden of funding public services falls disproportionately on traditional businesses and individual taxpayers. This erodes public trust and starves governments of the resources needed for progress. Striking the right balance is crucial for a healthy and equitable economic future. Fortunately, there are potential solutions on the horizon, most notably the global agreement spearheaded by the OECD and the G20. This landmark proposal is built on a two-pillar solution. Pillar 1 aims to fundamentally overhaul international tax rules by reallocating a portion of the largest multinationals' profits to the countries where their consumers are located, regardless of physical presence. This directly addresses the core issue of digital companies making money in a market without paying tax there. Pillar 2 seeks to end the race to the bottom on corporate tax rates by establishing a global minimum corporate tax. This would ensure that large multinational corporations pay a baseline level of tax on their profits, no matter where they book them together. These pillars represent a historic effort to prevent both tax avoidance and harmful tax competition. If successfully implemented, fair digital taxation could reshape the global economy in profound ways. With more stable and substantial revenue bases, governments would be better equipped to make long-term investments in critical areas like infrastructure, education, and healthcare. For businesses, the landscape would become more predictable and equitable. Companies would be incentivized to compete based on the quality of their products, services, and innovation, rather than on their ability to find the most aggressive tax avoidance strategies. This would help level the playing field, allowing traditional and digital firms to compete on more equal footing. What would this new tax order mean for the average person? For consumers, it could mean slightly higher prices for some digital services. As tech companies might pass on a portion of their new tax costs, however, the impact is expected to be modest. For small businesses, particularly local retailers, a fairer tax system would be a game changer. It would reduce the unfair advantage currently enjoyed by e-commerce giants like Amazon, allowing brick-and-mortar stores to compete more effectively. For startups, the design of these new tax rules will be critical. The goal is to ensure that the system targets the massive profits of established tech giants without creating prohibitive barriers for the next generation of innovators. In the end, the future of taxation in our digital-first world is about much more than just collecting revenue. It's about restoring fairness, ensuring stability, and rebuilding trust in the global economic system. The current rules were designed for a different era, and adapting them to the realities of the 21st century is one of the most important tasks facing policymakers today. While challenges remain, the growing momentum toward global cooperation suggests that a new digital tax order is not just possible, but probable within the next decade. This brings us to a final crucial question. The digital economy is borderless, but should taxation be too?